Welcome to Anchor Aspirant's monthly market commentary for May 2013. We welcome Peter Armitage, CEO of Anchor Capital and top-rated analyst of all time. The market has been very strong in May, despite concerns around unsecured lending and labour issues. Why is this?
Strangely enough, those sorts of conditions often lead to a strong stock market. And that's because those conditions have led to the rand weakening, particularly the labour issues. And a weak rand always leads to a strong stock market. And that's because 75% of the earnings on the South African stock market are effectively denominated in currencies other than the rand. So if the rand weakens, shares like British American Tobacco, SAB, MTN, which have a huge dominance towards markets outside of South Africa, tend to go up. And even the resource companies where the troubles are happening, if the rand weakens by 10%, their turnover has gone up by 10%. So, while there are issues and one should be kind of quite concerned, often the share prices of those businesses still go up. There's no doubt that the access to unsecured lending in the market has shrunk considerably. So the guy who was borrowing money, whether it be on a 1, 3, 12-month basis, he's going to find it a lot more difficult to access money from the unsecured lenders, the banks, the Capitec's and the Ables. And that can result in a bit of a kind of a freeze in the economy because he can't roll his loan, he can't replace the money that he's had to repay. So from a macro perspective and from an impact on the economy, in that segment of the market, it can result in quite a big slowdown. In terms of the actual companies involved in it, African Bank, I think, scared everybody. And because of the inherent uneasiness in terms of exposure to this marketplace, people have always got a bit of a suspicion about unsecured lending. Bad news in this space tends to have a precipitous impact on a share. And we saw that with Able coming down, a year ago it was sitting at 38, 40 Rand. It's now sitting at 16 Rand. It's now very cheap. It's trading below book value. And if indeed, as they say, they're now well provided, the share would have to be in value territory. That doesn't mean it can't hang around this kind of area for a long time. Capitec appear to have much more conservative provisioning, so we're less concerned about Capitec, but at the same time, the sentiment around it and the headlines that will prevail in the unsecured market can have a dampening effect on the share price for a while. But you can now buy Capitec a hell of a lot cheaper than you've been able to. And the big difference between Able and Capitec is that Capitec are covering 40% of their costs with transactional revenue, and that is likely to stay constant and grow. So the micro-lending portion might come under a bit of pressure. But another big dynamic in this unsecured market is the guys have been lengthening their loans. So you used to get a 12-month loan, you'll now get up to an 84-month loan. So much less of the loans are maturing each year. So even though their sales and new loans are lower than last year, their actual book, their net amount lent out is higher. So in Capitec's life, that can be 30-40% more than last year, even although their sales are quite a bit lower.
The rand has been very weak this month. Is it purely because of labour unrest and the poor GDP growth numbers?
Yeah, if you go back and look at the pattern of the rand, over the last 10 years, it's been closely correlated with emerging markets in dollars. So in other words, when the rand's weakened, emerging markets have been weak, and when they've bounced back, the rand has bounced back. Now, if you go back to August the 16th, 2012, which was the date of Marikana, those two became uncorrelated. So emerging markets carried on going up, but the rand started to weaken. So for the first time, emerging market fund managers are differentiating the rand from other emerging markets, and they're saying that can have an impact on our economic growth. The rand is in a troubled space, and you could well see a bit more of a spike. But if you look at when this has happened over the course of the last 10 years, there's been a sharp spike and then a retracement. I think it's fairly safe to say that structurally the rand is out of that kind of 7 to 8 Rand band and probably in the kind of 9 to 9.50 band. That's not to say that the rand can't go out of the top of that boundary and below. You've seen the sharp movements that can happen over just a few days. We would. There's probably a reasonable chance that the rand can spike some more from these levels, but our best guess, and that's really what it is, and that's why one has to diversify in investment portfolios, is that the rand would come back and settle in the kind of 9 to 9.50 range. The biggest concern from a South African market point of view is labour, and the sentiment that's being created around it, the unrealistic demands in a low growth economy, and the sentiment that creates around new investment. Somebody with a new 100 million rand to invest at the moment is probably not going to want to employ capital in a business that has a huge labor component. Now that's exactly what South Africa needs, is that kind of investment in order to grow its economy. So without that kind of investment, our unemployment continues to get worse. So the labor is kind of working against itself from a macro point of view. And while they might get big wage increases, there's going to be less people earning that kind of money.
Rand hedge shares have been very strong this month. Looking at Richemont, for instance, is this trend going to continue, or is it time to get out?
So the Rand hedge shares, and here I'm talking more about the industrial ones, so South African breweries, British American Tobacco, MTN and the likes, but specifically the ones that are listed offshore. So an SAB, BTI, that's British American Tobacco, and Richemont fall into that category. Because they're all kind of quite blue chip, predictable earnings businesses, they're all extremely expensive. South African breweries is the most expensive it's ever been. And you've had a great return in rands, because obviously it's done well in pounds and converts it through into rands. It adds another component to it. But so I think if one's been in them and made profits out of them, it's premature to bail out. But I think we'd certainly be lightening if the price continues to go up. You could, if the rand spikes, see another 10% jump in these share prices, and that's why we would want to retain some exposure. But I think, you've always got to come back to fundamentals and say, what's the growth rate of the business? What's the quality of the business? What P multiple should it be at? And I think few people will argue that against the fact that these things are very expensive. So, if you were to take a 3 to 5 year view from these share prices, you might well land up with quite a mediocre return, given that the two factors are earnings growth and valuation, and the valuation component could in fact come down over the next few years. I think quality businesses like SAB, because of the fear around the world, money's flooded into places of safety. As the world becomes more secure with its growth, the more cyclical shares like banks and resources and the like, as those re-rate, you could well go through a period of those outperforming versus the kind of what we call the places of safety or dividend aristocrats.
Pete, what can we expect from the markets in June?
Okay, so I think in the month of June, a lot of it is still going to be driven by the currency. So we're still positioned where we've got quite a few shares which have got currency exposure. In other words, get positively impacted by a weak currency. So we think there's a fair chance of the rand continuing to weaken. But we'll gradually take profits in those as they move through. You've then got to come back to fundamentals and find, what we're focusing on is stock-specific, bottom-up type opportunities in shares where we like the fundamentals and the shares are reasonable value. So shares that come to mind, it's not necessarily our kind of top buy list, is things like Netcare, is things like HCR, Sogo Sun. These are good quality businesses that haven't seen that kind of rush. We like Comair, we like RMI. RMI, which 40% of the assets are in insurance. June's going to be a very interesting month where they're going to launch a life insurance product, which we think will take the market by storm and create some quite positive sentiment.
Pete, thank you so much for joining us on the Anchor Aspirant Monthly Market Commentary for May.
Thank you, Mariska. And it's certainly going to be a hell of an interesting month to watch. The rand's going to be the driver, but the marketplace is certainly an interesting place. And back at Anchor Capital, we can't stay away from our desk for too long at the moment. The market movements are volatile, and we've got to stay on top of our game.
For more information, log on to our website, follow us on Twitter, and like us on Facebook.